We'll get started here in about 1 minute. Great, thanks everybody. I wanted to welcome everyone to today's audio cast, a preview of the CARES Act, the Defined Contribution Plan provisions. My name is Eric Daly. I'm Managing Principal of the Multnomah Group, and joining me on today's audio cast is Greg Johnson. Greg Johnson is a JD, Senior Consultant, and the head of our Technical Services effort. How are you doing this morning, Greg? A couple of housekeeping items before we get started. The first of which is we're trying to make this interactive. We are trying to get into some of the practical provisions and the very short-term decisions that retirement plan sponsors may have to make over the course of the next several days. As folks are likely aware, the President signed into law the CARES Act back on March 27th of 2020. Which was a very, very broad stimulus package that carried a lot of elements to it. That's some relatively material changes to, or at least potential changes to distribution options within the retirement plan setting. So today we thought we would talk through a couple of those and some of the issues that you as plan sponsors may need to wrestle with as you determine which of these features ends up being most appropriate for your organization based on where you are relative to the impact of the COVID virus. Greg, one of the things that we've been talking about over the course of the last several days, really since the 27th, is how these new provisions may impact plans. Can you kind of walk us through which of these provisions of the CARES Act are mandatory relative which ones are optional features that plan sponsors may want to put into place in their retirement plan?
Sure. My internet was a little spotty there at the beginning, Eric, so I didn't hear everything you said on the introduction. But as far as what is, there's two provisions that appear to be just available to everyone, and that is the delay of the loan repayments. So existing loans with a repayment between March 27th and December 31 have the opportunity to have a 1-year extension on the due date, and then the waiver of all required minimum distributions. Those appear to be the two that are just universally available to individuals. The other provisions, primarily focusing on some of the early withdrawal rules and the waiver of the 10% penalty there, and the changes to the loans appear to be optional. So an employer can elect to offer those if they want.
So the law seems to be intended to try and create more flexibility for plan participants to take money out of their retirement benefit program to address any financial needs that may have arisen as a result of the current pandemic. Clearly plans either do or don't have a loan provision. Clearly plans at this point either do or do not have a hardship provision. Maybe let's start with the hardship side of this. So for plans that already have a hardship provision, the CARES Act doesn't impact in any way the hardship provision. Is that true?
Right. This is not. This isn't an extension of hardship provisions. There are some safe harbors for the hardships. It's a separate and distinct, standalone withdrawal opportunity. It's got a limited time period. A lot of this ends, any opportunity to take these coronavirus related distributions ends at the end of this year. So there is a window on it as well.
So if we move into maybe the next level, plans either do or don't currently have loan provisions. So the mandatory portion, if you have a loan provision, would be the potential delay or suspension of loan payments that a participant may request. Did the CARES Act provide the option for participants to take more money out in loans than they might have had the right to under the current plan document?
Yeah, so it's an extension of the current loan rules limit it to $50,000 or 50% of an account balance. This extends that to $100,000 and up to 100% of the account balance. And this one has an even shorter window of availability though. That loan option is available for 180 days after March 27th, which is the day that it was signed into law. So that one will close down even earlier.
So, one of the things that plans have been wrestling with over the course of the last couple of years is trying to reduce the number of loans that are taken from a plan. And as a result, we've had loan policies amended year after year to try and reduce maybe down to 1, 2, or 3 the number of loans that are available. So let's say I'm a participant. I've already taken my required 2 loans or my available 2 loans under my qualified retirement plan, but clearly not up to the level of $100,000 or 100% of my account balance. Would there be a way for me to get access to another loan if I've already capped out the loans that would generally be available in my retirement plan?
Well, I think we're probably going to need some additional guidance to answer that. Now, the one thing about this is employers taking advantage of these provisions don't have to amend their plan until the end of the plan year in 2022. So I think there's an opportunity to, provide access to the retirement account balance and then, make the proper amendments when needed. So if it's determined, so in that example, if it's determined that maybe the act wouldn't have provided for the opportunity to take a third loan, I think you could certainly amend your plan to make that provision available.
So the waiver of the RMDs for 2020 is a mandatory provision. Effective 2020, all plans now have now waiving RMDs. Obviously, a participant could choose to take a distribution, but would no longer be required to under the RMD fees. So for plans that have loans, now all plan sponsors, via their provider, would provide participants the ability to defer loan payments based on the language in the CARES Act. But the optional provision then would be whether the plan wants to allow for the increased limits and percentage of account provided under the CARES Act legislation. Is that correct?
Yeah, that's my understanding.
So the big piece that we've been debating internally has to do with the early withdrawal that I think some people refer to, but you already referenced is not really a hardship. It's just a new type of distribution. Can you walk through the provisions of what we're calling these CARES Act distributions and what the financial consequences to a participant would be if Plan A provided for this form of distribution and B, a participant chose to take one?
Yeah, I think the biggest thing is the waiver of the 10% tax on early retirement withdrawals. So if someone's under 59 and a half and takes a withdrawal, they don't have to pay the 10% penalty. Now, keep in mind, well, there's also not the 20% tax withholding on that withdrawal as well. So, but people need to remember that this is still a taxable distribution. So they are still going to have to pay taxes on it. The one benefit though that is fairly unique and, unlike other types of withdrawals, taxable withdrawals, is that you actually have the opportunity to spread the reporting of the income tax over 3 years. So that allows you to sort of reduce the tax burden on that withdrawal. The other piece of it is, who's eligible for this. So it's these are deemed coronavirus related distributions. And they're available to individuals who've been diagnosed with coronavirus or their spouse and dependent. If a spouse or dependent has been diagnosed with coronavirus, you'd be eligible. Also eligible is a pretty broad category of anyone experiencing adverse financial consequences as a result of the coronavirus. So that could be anyone who's been furloughed or laid off, if your work hours are reduced, if you can't go to work due to childcare issues, if your employer can only employ you at a part-time basis, perhaps. So those are all examples. And employees are allowed to self-certify. So employers really don't have to collect a lot of information to confirm that someone has actually suffered this financial hardship. So again, I think it's, we're talking about pretty broad access to the retirement accounts under this act.
So, unlike, the previous RMD and loan discussion, these types of distributions are optional provisions, not required under the CARES Act, but new opportunities under the CARES Act for plan sponsors who want to extend that benefit.
Yes.
So, if we look at the various, because this has been the big debate, as Greg knows, we've had, umpteen calls internally on this. The loan provision is pretty clear. It extends additional benefits. It does require participants repay the loan, which is going to have its own potential challenges for someone who may be experiencing financial hardship. Then under the CARES Act, it clearly provides for these forms of distribution. For instance, if you're experiencing a financial consequence in so much as you've been furloughed or laid off, you've had your work hours reduced, at least in the case of furloughed and laid off, those participants normally would have been eligible for a distribution anyway, right? They would have been separated from service. The benefit here being that they could have their tax bill spread out and the early withdrawal penalty removed. And if I understand it correctly, the ability at some future date to repay the amount of the distribution that they've taken.
Yes, I should have included that. Yeah, they have the ability to repay it within 3 years. My experience is that doesn't happen very often, that individuals do repay that. But if they do decide that they want to get that money back into their savings, their retirement account, they can do so.
So the third category, so loans, the terminees taking these COVID distributions, and then the third is being able to take what essentially is an in-service distribution with self-certification of an amount up to $100,000.
Yeah.
Okay, I got you.
One point on that, just typically a hardship, when you think of individuals taking hardship withdrawals, you really want that to be sort of the last resort, the last option before tapping into your retirement savings. And I think it's very beneficial that, people suffering severe financial pressure right now have the opportunity to access their retirement savings. But individuals really need to think about what the long-term impact is, because $100,000, when you think about current contribution limits, if an individual takes $100,000 out of their retirement account, I mean, that took them a minimum of probably 5 years to save that. And, I do hope that individuals give some hard thought to what the impact of this could be on their ultimate retirement date and their ability to retire successfully. Because I think it will be substantial if a lot of people take this. At the same time, we're in very unique times, and if people have to have access to that money, then I think it's good that it's available. But just as long as people are thoughtful about accessing it.
So a question from the attendees today. So if an employee isn't furloughed, but perhaps their spouse has been furloughed, would they be eligible for a COVID distribution if the employer chooses to provide that provision in their plan?
That's a good question, and I think the answer is yes. Again, you're self-certifying the financial hardship. So my sense is, everything I've seen, the answer to that would be yes, but we might need a little more guidance to be certain on that.
So the other question that's popping up, frequently as we have internal discussions, is what the process is. So, what we're finding from providers, at least at this point, is at least in some cases, a race to be in a position to provide these forms of distribution to participants, despite the fact that they're voluntary forms of benefit, meaning they're not required to be provided. At least as we've talked about it internally, taking $100,000 in-service distribution is a pretty material change in plan structure. What are your thoughts on what types of discussions clients should be having internally to determine which forms of these benefits should be extended versus which ones perhaps should be delayed or deferred?
So that brings up an interesting point, because I think the other unique aspect of this is that it provides access. From everything we can tell, it does provide access to the entire balance. And one of the things, as I've worked with a lot of plan sponsors, especially those with very rich plans, so if you have a very healthy employer contribution, my experience over time has been that employers are oftentimes very protective of that money that they put into the individual's retirement account. So I think one of the considerations would be, do I only want to offer access to maybe a portion or certain contribution sources to employees? That would be one consideration, rather than opening up to the full balance. I think from talking to some plan sponsors, though, that could have some administrative challenges with it. And so if that's something you want to consider, I think you definitely want to work with your record keeper to understand how quickly they could maybe implement that if you do want to have limitations on what's available. Is that what you were asking, Eric? I'm not sure I answered your question.
No. I mean, I think it is. I think the internal discussions, for those who aren't aware, we've got a technical services committee and a vendor services committee. The technical services committee being analyzing the forms of benefit, which is what we're discussing here. At the same time, our vendor services committee has been talking to providers. So, for instance, Fidelity is arguably the largest defined contribution provider in the marketplace, has gone through a negative election process, and by negative election, essentially saying, hey, we're going to provide this form of COVID distribution to all plans unless you opt out of providing that, effective end of day today, which is in part some of our urgency to get this messaging out to clients. They seem to be on the earliest wave of implementation in a lot of regards, but it does seem that some clients may want to have discussions, because as we talk to plans and plan sponsors, ultimately there are clearly organizations that are already hurting dramatically, and as a result, their employees are hurting. There's going to be a mass loss of jobs in specific industries and in specific organizations, and trying to provide as much flexibility to those participants as is possible to minimize or at least utilize the resources they've accumulated to help mitigate the damage of what's happening economically is critical. We have on the other side healthcare institutions or other organizations that may be hiring, candidly, and as a result, the direct employee impact of the COVID virus, at least today, is not yet impactful. So opting into these large-scale in-service distributions without at least having some conscious dialogue at the plan sponsor level about whether we have other resources. Is our healthcare plan adequate? Do we have other resources to help make sure that this virus doesn't hurt our employees, or do we really need to tap into, again, back to your point, Craig, what's taken 5 years to accumulate? That's going to have an impact ultimately on the financial health of participants if we don't utilize the better sources and having some dialogue about those topics.
Yeah, I think that's a good point. As you think about, I think some employers, so you brought up the opt-out idea, and that Fidelity's deadline, I think, is today. I think some employers feel like, well, wait a minute, is it okay if I opt out? I think it is okay if you opt out of offering those provisions. And our understanding is that, when you decide, or if you decide later, wait a minute, we really need to open this up and allow this, it's not going to be that difficult to do it. Now, as I mentioned earlier, if you're limiting sources, then it gets a little more complicated. But if it's just a matter of, calling your record keeper and saying, go ahead and turn it on. We do want to offer it. Everything we've seen so far suggests that that should be, be able to be completed fairly fast. And so if you're looking at this and thinking through it and feel like you maybe have an investment committee, and whether it's a vote by email since everyone's working from home or what, but if you feel that you want input from maybe the whole committee, I don't think there's harm in opting out of providing it until you feel that you've thoroughly vetted this and determined whether your employees truly need it. The one thing I will say though is, there's some ability to access hardship distributions for any of the states that have been determined as part of the safe harbor on the hardships is for states that have been determined by FEMA to be disaster areas. And I think it would be pretty easy to maybe say, well, maybe that's sufficient if people can access it for that reason. The only thing to consider there for your employees is it is a nice benefit if you are going to take that money out to be able to spread it over 3 years. And that is only available under the coronavirus distributions.
And that'll be the interesting thing, I think, to watch for from a guidance perspective, right? There's factors that are going to be decided by the Secretary of Treasury. I'm sure there's other guidance that's going to have to be provided by the Internal Revenue Service. If you look at hardships in these COVID in-service distributions, it seems, for instance, we have a client who just experienced a really nasty tornado, 2 nights ago. That did extensive damage across the community and is going to have a huge impact on the employees that work there. At some point, it doesn't seem unreasonable that someone would reconcile the hardship provisions and say, why is a COVID distribution not subject to a 10% early withdrawal penalty, but another type of hardship is, when essentially all a participant now would have to do is, instead of taking a hardship, claim it was a COVID-related injury and avoid the 10% early withdrawal penalty. So it'll be interesting to see if there's any reconciliation of some of the provisions to make them more rational. Because the big debate internally has been, again, clearly for a participant who's been furloughed, providing them relief from withholding, or providing them the ability to spread out the tax burden and to not pay a 10% penalty is from my perspective, a no-brainer from an implementation perspective. Opening the entire plan, all sources, up to 10% self-certification early withdrawals may be necessary, but it probably is at least worth having a rational discussion. Another question, there's some questions about the timing of opting in or opting out. Did you say you had to make a decision today, or how do we opt in or opt out later? That's really going to be vendor specific. So the act's been passed. So the ability to utilize the provisions at this point likely comes down to the capabilities of your provider. So, our clients work with about 20 different providers. There are 2 that seem to be moving more quickly to implement than others. So for instance, Fidelity, based on our discussions with them, are going to be providing all of their clients the COVID in-service distribution provision unless a plan sponsor notifies them by end of business today that they wish to opt out. And by opt out, again, that could just mean delaying the implementation until you've had a chance to have a discussion. But for those clients that are with that provider, tomorrow, if a participant called and said, I need a COVID distribution, I'm self-certifying for $100,000, they would get a distribution across all sources. The other one on the tax exempt side that's moving relatively quickly is TIAA. Their COVID package is to make all of the provisions, the distribution provisions of COVID available for clients effective immediately. So those clients would also likely need to move more quickly to have some discussion. And part of it just comes down to operational challenges. How does your plan operate? If you have multiple vendors, who's going to be, and how are we going to be tracking limits that are put forth on how much can come out of the plan? There's a lot of guidance to be provided. And while some organizations are likely being hit by the COVID impact and their participants are facing it immediately and intimately, and therefore you may need to move more aggressively, I would argue that many clients probably have at least a handful of days to give some consideration to what the consequences are, make sure that all the various stakeholders have an understanding of impact, and they're making a decision about which of the benefits they wish to extend or not. So those are the two providers where I think the decisions, at least of the 20 that we have experience with, seem to be moving more quickly. Others, I think, frankly, are still trying to work through some of the consequences of the action. One of the things we were discussing yesterday is, while the ability for a participant to suspend loan payments, thereby not defaulting on their participant loan, is a mandatory provision, I could very easily see a scenario where a participant was furloughed yesterday. They had $10,000 left on their loan outstanding. The requirement is that they have their loans receive a full year extension, thereby meaning that my loan payment that was due today on the 31st ultimately is now due, or now I don't need to make until the 31st of 2021. If I'm a furloughed participant, I'd probably rather have that loan forfeited today, considered a COVID distribution, receiving the preferred tax treatment. So there are a number of relatively complex plan operational features that have not yet been resolved, and I think have to be discussed, or at least should be discussed, by committees to make sure that there's an understanding of how they operate. So with that, I'm going to open it up for a couple of questions. I know we only have you for 30 minutes. One of the documents that we had distributed certainly was a copy of the provisions of the defined contribution piece, which go through both the optional and mandatory provisions. From an advice perspective, the advice we would give clients, and have been working aggressively to do so over the course of the last 2 business days since the bill was enacted, is that this is a material decision for clients to make. It has a material impact on the plan, and it also has a material impact on participants. There is some optionality, right? There are things that are required, the RMDs, the extension of loans, but there are some other features and provisions that ultimately should warrant some discussion about loans and how we're going to process, and do we want to increase availability? How do we want to treat folks who are furloughed? And how do we want to treat folks that have not? And do we want to extend those in-service distribution provisions with self-certification? And do we understand the operational consequences and the retirement preparedness consequences of those decisions? So I'd encourage you to have those discussions. One more question from the field. If an employee delays loan repayment or does an in-service withdrawal, can they still contribute to the plan? So I think this goes back to the old hardship provisions, Greg. Do you have any thoughts on that?
Yeah, they would be able to continue contributing, and sort of on a similar, it's not the exact question asked, but that repayment over 3 years. So if someone is paying back their coronavirus withdrawal, that does not count against their limits either. So they can continue to contribute in the plan.
And then how about the availability of these features? I mean, these again are big changes. How soon would an employer need to notify participants of the availability of both the mandatory and optional features of the CARES Act?
I don't know, Eric, I might throw that one back to you. I think, I think they're available now. Right? So assuming you are opted in by your record keeper, those provisions are available. I've seen some record keepers, I think, are preparing to do some communications themselves on this. So I think you should definitely check in with your record keeper, see what communications they might have available that you can take advantage of. But to the extent these benefits are available, you do want to go ahead and communicate them to your employees and let them know that it's an option.
Yeah, I think so what likely is going to happen in most cases is there is some reticence to communicate, hey, everybody can get $100,000 if they want it tomorrow, just self-certify. My guess is that most providers are going to elect to use the summary of material modification, which probably isn't going to go out until next year. So there's the issue of when you have to communicate it, which is probably the SMM. There's the second issue of, do you want to communicate it? And again, I would be cautious. There's a pretty large amount of behavioral finance data and research out there that supports, the more that you promote the availability of these sources, the more heavily they're utilized. And ultimately, what you'd probably like if you choose to extend them is the participants who are most in need, rather than kind of promoting their availability. One last question, what are the mandatory provisions again? Really, the only two mandatory provisions are the waiver of the required minimum distributions for 2020. So any RMDs, this is not tied to the Secure Act delay of 70.5 to 72. You could be 89.5 years old this year, and you are not required to take an RMD. So that element is required, and your providers will be doing that in an almost automated fashion on the back end. The second is the extension or the dismissal of loan payments for a period of up to 1 year, meaning a participant can call and say, I need to defer my next loan payment, and they could push those out for a period of 12 months. So those two provisions are required. Any of these additional methods of taking more money out of the plan are all optional to plan sponsors. So Greg, thanks for doing this with us, and for all of you out there, thanks for participating. If you do have questions, please feel free to reach out to us directly. For clients, feel free to reach out directly to your consultant. We've all been working on this project kind of again over the course of the last 2 business days to make sure we've got good answers for clients. And we look forward to talking to you again soon. Thanks for your time.